Hey, good afternoon, everyone. Marty Missouri here, Friday, 27th of August, 2021, with your weekly macro update. Probably going to break the record today in terms of speed. I'm just going to rifle through, believe it or not, 5 graphs, 4 that move the needle on our index this week. One I just want to show you. Can't help but talk a little bit about the Fed news today. Fed Chair Jerome Powell spoke at their annual Jackson Hole meeting. It was highly anticipated. He did what I want to say the market feared he'd do, but man, he did a bang up job. The goal was to signal that the Fed is going to cut back on the $120 billion a month, 80 of which goes toward the purchase of Treasury securities, 40 mortgage-backed securities. Cutting that back a bit, he says that it's kind of the consensus view of his group that they should do that by the end of this year. But, there's Delta and more data to come in and so on. But from an inflation perspective, and I'll talk more about what he said about inflation, and from their goal related to jobs, which is something they tend to really emphasize, although the emphasis in this speech was on inflation, that they're making headway enough to maybe they don't need to do what they're doing. And we've spent a lot of time talking about quantitative easing, which is what I just described, and whether or not it really is something that is efficacious when it comes to the objectives of the Federal Reserve, or is it something that is very successful at blowing asset bubbles and creating massive wealth inequality, which is a big concern for society these days. So that's a debate. So you can sense the cynicism in my voice. But we're going to have years to tackle that going forward. With regard to inflation, wow, he really hammered that topic and needed to I think keep traders engaged. And as I speak, market's having a really good day, but we're getting close to the close. Essentially, utter denial that there are structural forces in play, continues to use this term transient to characterize inflation, says that it's really falling on a narrow mix of areas of the economy. I resist that notion vehemently when I read all the surveys and look at all the various areas that inflation is rearing its head. And of course, I'm a consumer, as is the rest of my family, and you all are too. And we know there's quite the broad stroke when it comes to inflation and its impact on the economy right now. We have really hit that narrative hard, and we're going to continue. But there's much more at play than simply bottlenecks created by COVID and so on, in terms of just everything from globalization, which he mentioned, and trends there, and populism, and other factors, many of which are going to affect inflation, we think, differently than it has the last several decades. But there is certainly a transitoriness to what we're experiencing. Of course there is, and of course that will calm down. It's what we're left with, and the stickiness of wage increases and all these other structural factors that I keep alluding to. So why do they keep talking about it, this transitory concept? Well, it's because we have historic debt bubbles, particularly in the government and the corporate sector, under the surface. And if inflation were to be a real longer-term thing, and the Fed was to truly do what they are mandated to do, well, then they'd have to act in somewhat aggressive fashion, we think. And if they do that, i.e. raise interest rates ultimately, well, that is going to be problematic with regard to this debt bubble I keep talking about. So as I've written on the blog, and I think I've mentioned on the videos, we're back to, a 1940s type scenario. And I think ultimately it will be yield curve control. And then lastly, about inflation, frankly, when you think about debt to GDP, traditionally we inflate that away. So, suppress interest rates, inflate the economy, ideally at a pace faster than the debt grows, and we wake up like we did in 1951, and we have a lot lower than 100% debt to GDP. So I think that's the playbook, whether or not they admit to it or whether or not they even realize it just yet. And that is a resoundingly bullish setup for things like gold and a lot of our other commodity plays and so forth. So as I've said time and again, suffice to say, getting the inflation narrative right is going to be key going forward. So it's going to just be ongoing crunching of the data, remaining open to all possibilities, hedging where necessary. We hedged a bit more this week, some of the real exposed areas that we see going forward. It's cheap to do when stocks are so high, which is nice. And try to continue to eke out a decent rate of return. And, protect against those big waterfall sell-offs that tend to occur when you have setups like we have today. So, okay, without any further ado, our index broke even this week. 2 of the indicators moved up, 2 moved down. So basically we're still at 14.58. For starters, mortgage purchase apps actually moved that to neutral. We've had a couple good weeks there. We'll see if we're not bottoming, and mortgage purchase apps rate of change is improving. Durable goods orders was a negative, down 0.1% month over month. Heavy truck sales continuing to roll over, as you can see here. So not a good sign. Truck tonnage was down as well, but didn't change our score. So I'm just going to show you the heavy truck sales. The Chicago Fed National Activity Index peaked up nicely to 0.53. So there's 85 individual indicators in their particular index. So it's really an economic index within our own. 56 of them were actually positive, 29 were negative. And then lastly, not a needle mover, but I like to show commodities. Certainly it's an important position for us, the commodity space right now in our core portfolio. Last week, remember, we were pushing the lower bounds of this range that we're kind of establishing in here, and then breaking out above that as we speak right here. So we are, for obvious reasons, if you've been listening to our narrative, very bullish on the commodity space, probably for quite some time going forward, but we'll continue to do the work both fundamentally and technically and position accordingly. So folks, I am going to stop right there, and thank you, as always, for watching and listening. And of course, lots and lots more coming your way on the blog in the days, weeks, months, and years to come. Take care. Have a great weekend. Bye-bye.